Today we're going to discuss quite an important topic, that is how to improve the cash flow position of a business. And this primarily, this is from Section 5, Finance and Accounting. And people who've been practicing the past papers, they would know that, this is quite a frequently asked question. Suggest ways and means of improving the cash flow position, or how to bring about an improvement in the liquidity position of a business. So keeping this particular question in mind, we are going to go through the methodology or the ways and means that are generally effectively used by businesses for finding a solution to a liquidity crisis, or if they plan to improve their cash flow position, right? These are obviously liquidity and cash flow. Obviously, they overlap, they're linked. Okay, first of all, before we start focusing on the actual techniques that are used by companies, by businesses for accomplishing this, we need to know what the term liquidity means. Liquidity obviously is the ability of a business to pay off its short-term debts, right? Ability to pay off short-term debts, that's liquidity. And cash flow or net cash flow, again, very commonly used. It is simply, a comparison of the cash inflow and outflow, right? The comparison of the cash inflow and outflow resulting from transactions carried out over a given period of time. Usually we, refer to a cash flow forecast if, the anticipated transactions are under discussion, and a cash flow statement, obviously, depending on or involving the transactions that have already been carried out, right? So, when we are required to identify, the methods that can possibly be, adopted by, or the measures that can be adopted by a business to resolve a liquidity crisis or improve its cash flow position, basically, the purpose is to ensure that the cash inflow increases. You have to adopt measures for improving the cash inflow, or and keeping a check on the cash outflow. In very simple terms, even if you're not familiar with this, even if you have not done this previously, you just have to, think of a method that can be used for improving the cash inflow or reducing the cash outflow. Simple as that. So in this regard, the most effective strategy that can be adopted by a business for resolving a liquidity crisis or improving its cash flow position is to adopt a tight credit policy. A tight credit policy, and you find this quite handy once you start attempting the questions in the past papers. This is quite relevant to numerous case studies that we've seen. And adopting a tight credit policy, that entails that a business is supposed to exert pressure on the debtors, right? If you start pressurizing your debtors for an earlier payment, if you start pressurizing your debtors for a prompt payment, right? If your debtors, let's suppose you've sold something on credit and they are, they're making the payment or the repayment after 90 days, for instance. So if you adopt a tight credit policy that suggests that you will exert pressure on your debtors or on your customers, that they are required to make an earlier payment, a prompt payment, right? And if a business manages to execute this plan, the cash inflow obviously will improve, right? And this will add a touch of stability to the financial health of a business, or the financial or position, or the cash flow position of a business, right? Pressurizing your debtors for an early payment. But try to remember that most of these questions, they are evaluation-based questions. When they say evaluate, for instance, evaluate two methods of improving cash flow. So you will explain the method first, like we just did, adopting a tight credit policy, pressurizing your debtors for an earlier payment. But then you have to evaluate your statement. You have to discuss how it might backfire, right? So I think if you use your judgment. If you pressurize your debtors for an earlier payment, it is quite possible that there will be a risk of losing your customers to your competitors. Obviously, if you keep pressurizing your debtors, then instead of 90 days, we want you to make the payment within 60 days. So there is a high probability that these customers, at least some of them, will approach a competitor and negotiate a better deal with him, and they might not decide to avail this facility through your company. So that's the risk factor, losing your customers to your competitors who might offer better terms and conditions. Similarly, when you're discussing credit policy, there's always a possibility of not pressurizing the debtors but offering discounts to them, right? You can always offer discounts to your customers, encouraging them to make an earlier payment, that instead of 10,000, pay 7,000 but pay now. This is a common practice, and this often works. So as a result of this, yes, the cash inflow will improve. You will receive the payment earlier, but again, the drawback or the evaluation is that there are monetary losses for the business. Though you are receiving the payment earlier, but instead of 10,000, you're receiving 7,000. So that is the monetary loss. That's the price you pay. So you have to learn how to evaluate your statements. This is very, very important. Okay, then another dimension, another aspect of the credit policy could be that instead of focusing on an improvement in the cash inflow, try to do something to control the outflow. Yeah, and in this regard, it is a common practice amongst businesses that they deliberately delay payment to the creditors, right? Pressurize your debtors for an earlier payment. If somebody owes something to you, try to take steps to accelerate this. And if you owe something to someone, if you owe something to your creditors, to bankers, to suppliers, try to delay payment. This is also like a strategy. Sometimes businesses, even though they have sufficient amount of funds, but deliberately they delay payment, by a few days, by a few weeks, by a few months sometimes. Why would they do that? Why? Because they basically, by adopting this strategy, there would be a temporary improvement in the availability of funds. There would be a temporary improvement in the availability of funds when you're delaying payment to your creditors, and you can, invest those, you can utilize those, in a way that is, that is in the best interest of the organization. Yeah, availability of funds, and control the outflow, at least temporarily. But of course, this can also backfire, because when you delay payment to a bank or to a supplier, there will always be late payment charges. Then there's a cost of borrowing involved. That the interest rates will come into effect. That can prove to be costly, and not only that, you might lose your credit worthiness. That's very important. Credit worthiness is financial credibility. If you delay payment, and if you are unable to meet the deadline, intentionally or otherwise, your credit worthiness will be compromised, and quite possible that next time these creditors, these suppliers, bankers, they might not be too keen on offering a credit facility to your business because of your poor credit history, right? So this is how you discuss a credit policy with reference to bringing about an improvement in the cash flow position, right? So this is important. Then we're already familiar with JIT. Remember, just-in-time stock management. So keep in mind, when you're discussing a question in which you are evaluating ways of improving cash flow, in addition to the one that I just discussed, a tight credit policy, JIT stock management often proves to be quite useful. I've discussed this in detail previously also in lean production in section 4, but with reference to this particular discussion that we are having, regarding cash flow. If a business switches from bulk buying to a just-in-time stock management, from bulk buying to a JIT stock management, that can also go a long way in improving the cash flow position, right? So by switching to a JIT stock management, just-in-time stock management, you're trying to ensure that your funds are not tied up, because when you buy in bulk, your funds are tied up. You're spending a lot of money, you're purchasing something in a large quantity, your funds will be blocked, your funds will be tied up. But in JIT, on the other hand, as we have an idea, a low level of stocks is maintained and inventory is purchased in a smaller quantity in accordance with the immediate requirement. Stocks are purchased not in excess, but in accordance with the current requirement, right? This is what JIT stock management revolves around. So when you switch from bulk buying to JIT, that can also bring about an improvement in the cash flow position of a business, because your funds are not tied up. You're spending spending smaller amounts of money, and the amount that you have, you can use it in a more productive way elsewhere, right? So JIT, it could also be an important part of the discussion whenever this improving cash flow is being considered, or you're trying to find a solution to this problem, right? But this can also backfire, because you have to evaluate. JIT, there are the drawbacks also associated with JIT. Yes, JIT is very useful. I just mentioned your funds are not tied up, and then JIT helps in reducing the stock holding costs. Warehousing costs are reduced because you're maintaining a low level of stocks. Wastage is reduced. There are fewer chances of obsolescence. The stuff that you have, it won't become outdated. And of course, JIT is more flexible than bulk buying. You can make quick adjustments in accordance with the changing purchasing pattern of customers. But having said that, the drawbacks also. JIT is riskier because there's too much dependence on suppliers and workers. You can't have a laid-back approach in JIT. And of course, there are no economies of scale. Most importantly, there are no economies of scale, because economies of scale are associated with bulk buying. Yes, of course, drawbacks should be discussed, but JIT is quite relevant to a cash flow related question, right? And in addition to a tight credit policy and JIT stock management, source of finance can also prove to be quite helpful here. That instead of making full payment for whatever you're buying, you try and avail, a bank loan or something, use a source of finance, right? And instead of, blocking your own funds, you borrow from a bank, make the investment, start generating revenue, use the amount to repay the amount to the loan. So selecting a suitable source of finance could also be an important part of the answer in response to a cash flow related question. Using a better source of finance, right? Instead of relying on your own funds, you avail a financing facility. It could be a bank, it could be any other institution, it could be a hire purchase facility, right? So keep sources of finance in mind also. I have already discussed source of finance in detail in another lecture previously. This is also part of section 5. So just keep in mind, mainly these are the ways and means or the methods that businesses usually rely on when they intend to resolve a cash flow crisis, right? Hopefully you will find this discussion useful. This should be it for now. Allah Hafiz.